How much is your loan costing you? How do you compare your loan when you're shopping for lenders? Well, that's two of the things that we're going to dive into today as we talk through the loan estimate. Now, Josh, we've done a similar episode to this in the past where we've walked through the loan estimate, but unfortunately, we didn't actually have the loan estimate there on the screen. And this time, we're going to actually walk you through it because we get a lot of questions around how you look at the loan estimate, what fees go to where, how do you compare lenders, all of that good stuff. So if you're listening on the podcast, it would be helpful if you bring up the video just because this is actually going to walk you through that process. You're going to know exactly what we're talking about, and it's going to make a lot more sense. So Josh, with that, where do we start with the loan estimate?
Well, let's do a big picture overview before we jump in. So up on the screen there, we've got page 1. The loan estimate is 3 pages. Let's talk about what is on those 3 pages before we go into detail, because they're all very, very different.
Well, let me back you up real quick, Josh. Sorry.
Sure.
What is the loan estimate? Let's start there, like really broad overview.
Let's go really old school. Before the government finally stepped in and said, hey, a good faith estimate that has no laws or legal teeth around it leaves it open to either unethical or ignorant loan officers to give you wildly incorrect numbers. It's a small piece of the puzzle that led to the problems that we had before 2007. And as a result, we now have the TILA-RESPA integrated disclosure laws that dictate you get a loan estimate up front, and then at least 3 days prior to signing your loan documents, you're going to get a closing disclosure. They're very similar documents, and we're going to talk about tolerances within the loan estimate. The loan estimate sets maximum tolerances. Many of them are 0%. They cannot change at all between your loan estimate at the beginning and your closing disclosure at the end. But that is what it is. It gives you an overview of your situation. Many of the things where people felt like they were misled in that period of 2003, 2004, 2005, they didn't know their loan was going to adjust. They didn't know they had to pay taxes and insurance, and the little tiny payment was only the principal and interest. So what I will say, I'm going to point out a couple of nitpicky things that I really don't like about the loan estimate that are pretty lame, considering we had a 2-year comment period where the government took comments from the industry of how to perfect this form before rolling it out. It still has 2 or 3 pretty silly flaws in it, but overall, it is 1,000 times better than what came before it, and we should have had something like the loan estimate all along. That being said, Jeb, we're talking to those of you that are home buyers. If you're talking to a loan officer and they're getting you pre-approved, the first step is generally not that loan estimate. They're going to give you a fee worksheet. They're going to give you a comparison sheet to show you, hey, this is what FHA looks like versus conventional. This is what FHA looks like versus USDA if you're in an area where that's eligible. So that process starts differently. With the loan estimate, you're generally fairly far into the process where we have a property and we know what type of loan you're getting, and we're getting real serious about getting you very accurate numbers.
Very good. All right. So good stuff. So we have the loan estimate up here on the screen. What is, I guess, a broad overview? You mentioned 3 pages. What are we looking at?
Yeah, so page 1 is just an overview of your entire transaction. So we're going to go into what that overview gives you, but in broad strokes: loan terms, payments, cash at close, type of loan you're getting, and whether it's locked. Page 2 is really the heart of the matter, which breaks down. Page 1, that overview is really a summary. Page 2 is the breakdown. It's like, okay, you tell me I need $22,000 at closing. Where does that $22,000 come from? So we're going to spend most of our time today on page 2 because that's where all the magic happens. Then page 3 is kind of the dumbest one of all, sort of a catch-all. The government calls it additional information. I would say it's unnecessary. We'll spend a couple minutes going through that. When you see it, you'll realize that most borrowers also think it's unnecessary and don't really look at it and pay much attention to it.
All right, good stuff. So with that, Josh, let's just dive in and start at page 1 and really give, the detailed information, what borrowers should be paying attention to, and really kind of walk them through this process.
Absolutely. So the numbers that you're seeing on screen, what we're coming up with, this is from the CFPB's example. And remembering this is 10, 12 years ago that they put this out. So we're going to see a really low purchase price of $162,000, where in most parts of the country, that's not realistic. But this, I like this form because it gives us real numbers. Numbers in every box in page 2, so you can see what they look like. So ignore the super low purchase price. Everything else is pretty good. So let's look at the top there.
The rate's fantastic.
I didn't even see. We got 3.875. We would all love that rate. We would love to buy a house with $162,000 loan amount.
I like everything I'm seeing here.
A 180 purchase price at 3.875. So if we can all get the time machine back to when the CFPB did this, we would all be very, very happy. But you look there in the top, it says the date this was issued, the applicants, meaning you, the borrower, the properties, give us a property address, the sale price, and then we go loan term. Purpose, is the purchase or a refinance? Product, is it a fixed rate? Loan type, conventional FHA or an other loan, or VA or an other loan type. It has the loan ID, which is generally your loan number, so we can actually tie it back to a real transaction. And the big one here on page 1 that I always like to point out is rate lock. So in that top section, you're going to see a box going to say, is the rate locked? No. Is the rate locked? Yes. This document is not meaningless without a rate lock, but all of the important details, meaning the interest rate and your box A charges, can change if that is not locked. So you will notice in there, if it says no, we still have to put a timeline as to how long these fees are good for. So the interest rate and the charge for the interest rate can change, but the rest of the fees in there still have to be accurate. So even if it's not locked, it is a helpful document. But that's the most important thing, Jeff, because honestly, I have people all the time that tell me, oh no, yeah, we locked our rate last week. I'm like, okay, well, cool. Send me the loan estimate. I'll do a second opinion, take a look, tell you if you're in good hands. They send over the loan estimate and I go, it says right here that you're not locked. What? We locked it last week. So that's an important part of that document.
So let me ask you this question, Josh. So say you get this document initially and it's not locked because your loan's not locked, and then it is locked. Do you automatically get a new loan estimate immediately when that happens to be able to compare in your case? Or is there some cases where they still just have that old one in their hand and maybe it has been locked, it's just not verified?
You will have to get a locked loan estimate. So again, the same timelines apply. Within 3 days of locking that interest rate, it has to go out. Most times it's going to go out the same day. When we lock it, it triggers it in our system to disclose a new loan estimate, but we only have 3 days to get that out to you. And, you will generally, most lenders will, for compliance in their file, they're going to have a rate lock-in agreement that they're going to want you to sign as part of that. But again, this is a good thing because prior to the loan estimate, we had loan officers would do this all the time. Oh yeah, I got your rate lock. No problem. And they're floating, hoping the market's going to get better and they're going to make more money. This spells out in clear terms that your rate is locked on what loan program and through what timeline. So that first header section there is the most important part. Moving forward to the loan terms, pretty straightforward. What's my loan amount? What's my interest rate? What's my monthly principal and interest payment? So again, no taxes, no insurance, but principal and interest on that. You'll also see this column here. Can this amount increase after closing? Well, 99% of our borrowers are doing a fixed rate loan. So no, your loan amount can't change. Most people are doing fixed rate loans. So that cannot change. If it's a variable rate, it's going to say, yes, it can change. So if you're doing a 5/6 ARM, a 7/6 ARM, a 1 month ARM, if you're really wild and adventurous, it's going to say that can change on you. The last two there are almost always going to say no. The example we have on screen says yes, but is there a prepayment penalty? Is there a balloon payment? So loans with a prepayment penalty don't meet the qualified mortgage guidelines. So any Fannie, Freddie, FHA, VA, USDA loan, never going to have a prepayment penalty. The more common loan types that have that are non-QM loans, bank statement loans, debt service coverage ratio loans, that type of stuff may have a prepayment penalty. And if it did, it would show you that right there. Same thing with the balloon payment. Balloon loans, I honestly, I haven't seen one offered in a long, long time other than like hard money loans where you're going to a private lender where they want their money back in 12 months. But if there was a balloon payment in 5 years, 7 years, it would spell that out for you. So again, this harkens back to the issues that we had 15 years ago where loans had these features and people weren't aware of them. So they put them right here on page 1. So the next section there is going to go through projected payments. This one, Jeb, is just not good in terms of the way the government did this. So what it shows you is years in this example, shows you years 1 through 7 and years 8 through 30. And you said, wait, it's a fixed 30-year fixed rate. So it's going to be the same all the way through there. What they're projecting is that the mortgage insurance would fall off after 7 years and it would go down. But for most loans, you're just going to see a years 1 to 30 for a fixed rate. So principal and interest, again, we already saw that in the section above, but now it tells you that plus your mortgage insurance, plus your estimated escrow. You're like, what's the escrow? Well, if I'm impounding for my taxes and insurance, they're collecting an amount of that every month. So in this example, we got 761 plus 82 mortgage insurance plus 206 estimated escrow for 1,050. So when we look, then the next box says breakdown of estimated taxes, insurance, and assessments. So you're like, well, 206, okay, I see that. So that's the property taxes and the homeowner's insurance. It shows you what that estimated escrow is. Well, the fun part is you could have that 206 amount, and then it comes down here, and this breakdown could be $356 if you had an HOA. So that always throws people off, and we don't ever really get a good and accurate picture of your total principal, interest, taxes, insurance, and association dues if you're buying a property with an association. So that breakdown, I get more questions on that than anywhere, and that could have been done better and should have been done better to eliminate many of those questions.
And just to clarify, you get a very clear picture in having the conversation with you. It just doesn't show clear on this document what that total payment is.
Everyone's always trying to add, and they go, wait, 1050, and then it says 206. The 206 is already up there. Or if we use that example, again, it's 150 HOA, that box would say 356. And they're like, wait, I see 1050 and it shows 82 and 206. These numbers don't match up. It's because the HOA dues show up. And the idea there was, make sure that everything is being disclosed to the borrower, that there's an HOA due. And there are other documents that you're going to get in your disclosures that will give you a breakdown. It's just, you would think this is the loan estimate. This is where this should be the one simple, easy place for you to see what is my total principal, interest, taxes, insurance, and association dues, if any, and it doesn't do that. So the last thing they do here again in this first summary page is closing costs. What are my total closing costs? And then it gives you a breakdown. It says, see page 2 for details. So we're going to go through that next. And then estimated cash to close includes closing costs. So see calculating cash to close on page 2, there's an entire box that shows you exactly how that's calculated. But on page 1, you can get a pretty solid overview. Jeb, when we talk about when I do a pre-approval or when someone gets pre-approved, what are the most important things for them to know? What's the max amount I can be pre-approved for? What is my total monthly payment? How much money do I need? So at this point, you can kind of see that you're now under contract. You have a property. We've disclosed the loan estimate, and you have all of those answers here. And on the next page, we're going to go into the details of what all that looks like.
Yeah. So page 2 is essentially going to outline some of these costs. So Josh, maybe I'm sure you're going to go through this, but of the charges that we see here on the screen, some are dictated by yourself, the mortgage professional, the mortgage broker, bank, whoever you're going to, lender wise. And then some of them are not, right? Some of them are controllable to some extent, and some are uncontrollable. So, I guess take the conversation where the direction you want to go.
Absolutely. And when we get there, Jeb, I'm going to throw it back to you, because some of these, we're in a heavily purchased market. 90% of loans right now are purchases versus refinances. So this doesn't vary a whole heck of a lot from a purchase to a refinance. But one of the big things that does vary when we're talking about purchases is the contract dictates many of these things. So many of the items that will fall under items you can shop for, technically you can, but you sort of gave up that right when you negotiated the contract, which may or may not say who some of those service providers are. So let's jump into the details on that. Jeb, we talk all the time. Box A is the number one thing that you want to look at. Those are first-party charges to your loan originator. So if they're a broker, they can be charged by the wholesale lender that's doing the loan. It's charges to the broker, the actual lender, anything that is not going to a third party. So people get spun out on this. I've got into debates with loan officer friends of mine. I have a friend who says box A should be completely empty, other than in this example, it shows a quarter of a point. You're paying a quarter of a point for that 3.875 interest rate. So there's always either a charge or a credit for an interest rate. And what he's saying is, I don't want to have an application fee, an underwriting fee, a processing fee, a doc fee, any and all of that. This should be empty, because I should have priced the interest rate to include everything that I want to make. And my point on this, and my point to you, if you're watching or listening, I don't care. You can put the craziest fees you want in here. The only thing that matters to me is they add up to $1,802. So in simple terms, that is the cost in points to get that interest rate. I've had people say, hey, I'm paying 0 points for my interest rate. And I get this and it says 1 discount point and like $2,000 worth of fees. And box A total is like $6,000. I said, that's not a 0 point or a no cost loan. You're paying $6,000 for that. So look at the total. And that makes it where you don't care what the lender is calling any of the fees. You're just saying the first party charges to get this interest rate are this much. There's a portion here where we're going to look later, something I've seen deceptive, that I feel is deceptive from some lenders. They will put a charge, a loan application fee or discount points up here. And then there's a section on here where we can show a lender credit, and then they'll have a lender credit to you. And they say, well, yeah, I'm charging you 1.5, but I'm giving you 3/4 of a credit. It's like, it doesn't make sense. There's a cost for a rate or there's not. You can't charge and then credit to offset some of that in most situations. So with that, Jeb, anything first party here going to your loan originator, the broker, the bank, the lender making the loan. And the most important thing here is once these are disclosed on a locked loan estimate, these are 0 tolerance. They cannot change. And the other items, this application fee, underwriting fee, they can't change even from a floating loan estimate. The only thing they can change is the actual charge for the interest rate. So the next one here is services you cannot shop for. There are things in this transaction that you are going to be charged that don't come to me as the loan originator or the bank making the loan, but you don't get to shop for them. The simple ones are your appraisal. You don't get to select your appraiser. That was taken away long ago. You don't get to select the credit company. We have one credit company we work with. So you're going to pay those charges. It's not a profit to me. I'm only passing along the actual cost of those, but you don't get to shop for them. So anything could fall under here. In this example that we're looking at on screen, flood determination fee, flood monitoring fee, tax monitoring fee, tax status research fee. Those are all things that may be charged on your loan that you cannot shop for. As a result, those are 0 tolerance. If you can't shop for them, we can't tell you it's $5 and then come back and go, oh, it's actually $500. So that is a positive there for you.
So Josh, when you're giving this loan estimate to somebody, where are you getting these fees from? So if there's 0 tolerance, meaning they can't change, how are you getting these fees on the estimate so that it's provided accurately to the potential buyer?
There's a couple ways to do it. In a perfect world, an ideal world, we are reaching out to the attorney, the title company, the escrow company, depending on where you're located, whoever's handling the closing, and we are asking them to get us all third-party fees. So any of these, box B, box C, box E, all of those generally come from the settlement agent, which can be an attorney, can be a title company, be an escrow company, depending on where you're at. Now, let's say I have a contract in hand. I have the 6 triggering things that say I have an application and I have to disclose. And I have this situation for a listener of the show right now. We're doing a refinance in North Carolina. They use attorneys. The attorney's office says, oh, it's in the queue. We're going to get you those fees. I don't have the luxury of waiting. I have to disclose within 3 days. So within that 3-day time frame, what we can do is there's a tool called Smart Fees. Most title companies have fee calculators, and we will go to those and basically overestimate everything that you might actually pay. So sometimes you might get a loan estimate that's going to show higher fees, and we'll tell you that. Say, hey, I need to get fees out, but these are not necessarily accurate. Once we get those third-party fees, we can redisclose a new loan estimate with lower numbers, but that 0 tolerance says they cannot go higher. And if something comes in and goes higher, you, the borrower, can't pay it. And I am as the lender, am held responsible for it. Even if it's not my charge, it's something from the title company, something from the escrow company. If we under disclose to you, we are going to be held responsible for that. So box C, simply just non-first party services that you can shop for. So in this example, a pest inspection fee, a survey, the cost of a survey, the title insurance binder, the title search, the settlement agent fee. So again, it can be title, that can be an attorney, that can be an escrow officer, depending on where you are in the country. So Jeb, why don't you walk us through what this means? So you can absolutely shop for these, but why is that not the way that it typically happens once you are reaching out and saying, hey, the Smiths, that's a bad example because you're the Smiths, the Joneses have a property under contract. Here's the contract. Please get going on that. How does that work in the real world when they've essentially already done their shopping or given up their right to shop in the contract?
Yeah. So when you're writing a contract, I mean, it depends on the type of market that you're in. And it's been a long time since, we've been in a position where I would say that the buyer's really in control of picking their own title and escrow fee. So you as a buyer can go out and shop title and escrow fees, but typically speaking, what we do is we say, hey, it's up to the seller. The seller's choice can pick the title company, they can pick the escrow company, and that's who we'll use because it's a seller's market. We want to give as much in favor of the seller so that we're, as an offer, we're looked at equally across the board. And with that, the title fees, while they're quote unquote, shoppable, they're not to some degree because they're being chosen by the selling side. Now, what I will say is you can say, you know what, seller, you use your company, I'm going to use my company. Typically speaking, when that happens, it's going to cost you more than just going directly with the seller because when they're dealing with both sides of the transaction, there's actually I would say a discount to some degree for dealing with both sides of the transaction. So yes, it is shoppable, but that comes with the caveats that we're talking about here. It is typically picked by the selling side. Now, me as a listing agent, why do I use a certain escrow company? Why do I use a certain title company? So if you were a buyer and you were coming to me and we said, hey, we want seller's choice of services, and you agreed to it, well, I'm picking title and escrow companies. For one, I'm picking an escrow company that I know is reputable. I know they're going to do their job. They're going to communicate. They're going to do everything that needs to be done. Same with the title companies, right? There are reputable title companies out there, and there are some that questionable to some degree. So we want to make sure you're protected as a buyer. We want to make sure we're protected, in this case, as a seller and as an agent. And so we're going with companies that we have relationships with. And sometimes if fees come up and it's, hey, Jeb, we're tight on this transaction. We can negotiate some of this stuff a little bit. We can go back and ask for some. Title is non-negotiable. It's kind of a fee that's there. We don't have any charge over that. In fact,
it's published with the insurance commissioner.
Yeah, most of these title companies should be more or less the same across the board, unless you're doing a refinance, in which case there's a different title insurance premium and that's associated with that. But on a purchase, more or less the same. Escrow fee, settlement agent fee that you're seeing here on the screen, that sort of thing, that can vary a little bit. But most of the time, it's based off your purchase price. It's based off, how much not how much you're financing, primarily your purchase price. So can be negotiated a little bit, but for the most part, as much as it says sellers services you can shop for, it's already been shopped. And it doesn't matter if you're using Josh as the lender or using your local bank, those fees that you see here are essentially going to be the same because they're all reporting from the same title and escrow company. So these numbers that are going to be the same regardless of the lender you decide to go with. There's no control from the lender's perspective when it comes to this stuff.
And on that subject,
unless it's a refinance.
Yeah, box A is going to vary from lender to lender. Box B is also going to vary, but very narrow ranges. So even though you can't shop for them, it's not like someone's going to go and say, hey, we have $1,000 appraisal fee when everyone else is at $600. Same thing with credit. They're all going to be very, very similar. So that's why we say when you're shopping, look at box A. You're going to notice here under services you can shop for, the lender's title policy. When you're getting a loan, you are required to get title insurance to protect the lender. We're going to see in here where if you are paying it, where the owner's title policy will show up on there. But putting a bow on services you can shop for, right after that is box D, total loan costs. Box A plus box B plus box C. So in this example that we're showing you here, $5,672 for the total loan costs. Again, one of my little nitpicky things that I wish they had designed this form a little bit better is the next box, box E, taxes and other government fees. Those are also loan costs to me, or closing costs, I should say. We generally differentiate in your costs are what are closing costs that you're going to pay one time at closing, and then what are ongoing costs of ownership that you prepay at closing, either to establish your impounds or to pay your first year's home ownership premium. So we're on the right side of page 2, and this is what we're looking at. So box E is generally recording fees and other taxes, and then transfer taxes. Depending on where you're at in the country, you're going to have very low transfer taxes. You're going to have very high transfer taxes. Doing a loan for a borrower in Pennsylvania right now, they're paying $6,000 in transfer taxes on a $600,000 purchase. So that can be a big number, and it's something that needs to be disclosed to you accurately. Recording
But
is
at the
pretty
end of the day, you
consistent.
have no control over it. It
You have
is
no,
what it
yeah,
is. Yeah.
Yep, you have no control over it. The lender has no control over it. Your choice of lender is not going to change that. This is going to be the same in box F. Box F, the next one is prepaids. So a couple things that we're going to look at is box F is prepaids. Box G is initial escrow payment at closing. And people get hung up on this because some of the same charges are in those boxes. So let's look at prepaids. At closing, this example for some reason shows a homeowner's insurance premium of 6 months. Most lenders are going to require you to pay the first 12 months premium. So you're going to shop. You're going to tell me, hey, I got an estimate and it's $1,200. So you're going to see $100 a month, 12 months, it's $1,200 there. The mortgage insurance premium. Most lenders don't prorate or collect anything prepaid at closing on the mortgage insurance. Prepaid interest. We've talked about this before on the show. The show is 15 days. If you close on the 15th of the month, the lender doesn't want a half payment on the first of the following month. They're going to wait till that following month and collect a full payment. But it doesn't mean they're giving you 15 days of free interest. They're going to collect it right here at closing. So with that, you're going to see homeowner's insurance premium, prepaid interest, possibly some property taxes that you are prepaying at closing. But the next box, box G, if you're going to impound, if you're going to include your taxes and your insurance and your monthly payment, we have to fund that impound at closing. So you're going to look and say, wait, these are the same items. Homeowner's insurance, $100.83 a month. We're going to collect 2 months. Well, why is that? Well, we went through that example. If you close on the 15th, on the first of the following month, you don't make a payment. You don't make your first payment till the following month. So one of those 2 extra months covers that timeline there. And we're actually at like 45 days. So you're only paying like a half a month extra in this situation. Same thing with the property taxes. The lender has to look and say, how many payments are you going to make between closing and when your property taxes come due? And it's going to tell us what that amount is. What I will say, I see dumb loan officers around the country quote people inaccurate numbers in here. And if you're in an area where property taxes are $800 or $1,000 a month and they short it by 4 months, you're $3,000 off on your cash to close. And I've literally had borrowers come to me and say, well, we're going to go with this guy. He's $3,000 less cash to close. I'm like, well, he's not. He just doesn't know how to actually disclose this number to you. So it's important that you get that figure accurate up front. Now, we talked about box H. This is other. Really the only things, almost the only things that ever will show up under other is an owner's title policy. So you'll notice it says optional. You are not required to have an owner's title policy. In California, 98% of the time, the seller is going to agree to pay that owner's title policy. So it doesn't show up on here. It's not a charge to you at all. But if the seller is not agreeing to pay it, you have the choice to buy it yourself. As Jeb said, you get a discount if you have a concurrent owner and lender's policy. So with that, you're probably going to be better off buying it, but this is where it would show up. We also, Jeb, sometimes get situations where the seller doesn't want to pay a home warranty. You're in a tight market, competitive. You say, hey, we'll pay for our own home warranty. That would be disclosed here as well. So moving along, the next box again is just another total box. So total other costs. Box D on the left side was the total loan cost. This is the total other costs. It's basically just adding up E, F, G, and H. So in J, we're totaling the totals. They take those 2 subtotal boxes, D and I, and add those together. And that's everything that you're paying for the loan, closing costs and prepaids. And they would also list a lender credit here. Let's say that the lender is saying if the rate is 7% at 0 points and you take 7.25, we'll give you a 1% of the loan amount credit. That's where that credit would be listed, and you would see that, and it would offset your total closing costs. So the next box is the calculating that total cash to close, which was summarized on the first page. This is where they want you to go and look at it. So it's that total closing costs, box J. Closing cost finance paid from your loan amount. That can be like a VA funding fee, FHA mortgage insurance premium would reflect there. But then we're going to say, what is my down payment? And then we're going to take away any deposit that is already accounted for. So a lot of times when we're sending out the loan estimate, the loan has not gone to underwriting and the underwriter hasn't validated and verified that you've paid that deposit yet. So for us, 9 times out of 10, when you're looking at this initial loan estimate, you're not going to see your deposit. So it doesn't mean we're not crediting it to you. It doesn't mean that it doesn't reduce your estimated cash to close. It just means it's not going to be on that initial loan estimate most of the time. So that would reduce that amount. Funds for borrower, I have no idea what that line item is there. Seller credits would be, as it states, if the seller is giving you a $10,000 credit. And then adjustments and other credits, there can be different things that can credit to you, and then it gives you your total cash to close. So big overview, that's where those numbers come from. When you're looking at comparing and shopping, you really only care about those box A fees, net of any lender credits to you. But it is very important to get an accurate estimate, an accurate loan estimate with accurate cash to close. So with that, Jeb, let's roll over here to my least favorite part of the loan estimate, which is the final page here. And that's funny. We're missing the actual full page in the slides here. But in looking at it, the reason why I say this is pointless is no one looks at this. Even when they look at it, they go, what does it mean? And if I tell them what it means, they go, why would I care? So we have comparisons. Use these measures to compare this loan with other loans. You tell me if these are in any way helpful. So in 5 years, the first line item is in 5 years, the total you will have paid in principal, interest, mortgage insurance, and loan costs. And then they also put an item, how much principal you will have paid off. So the next one is annual percentage rate. Jeb, we get this question all the time. Hey, you told me my rate is 6.875. This says my APR is 7.04. APR is a manufactured synthetic number from the government. They say you're actually not, unless you have no closing costs, you are not being loaned the full amount of the loan. So what they do is they take your monthly payment and your interest rate, and they say, well, what if they take your monthly payment at your interest rate, and then they take away from your loan amount the prepaid finance charges, which is the majority of the closing costs, but not all of them. And with that, they determine the actual interest rate. If you, in this instance, we had what, $162,000 loan amount, maybe there's $3,000 of prepaid finance charges. So if you had a $159,000 loan instead of 162, and you had that same monthly payment, what is the equivalent interest rate? The purpose of it,
if you held your loan for 30 years.
If you held your loan for 30 years. So the purpose is, hey, I can compare loan A versus loan B versus loan C. But as Jeb correctly pointed out, if I keep the loan for 30 years, that's accurate. And it's also assuming that every lender is calculating the prepaid finance charge and the APR correctly. So this is where I go back. Please ignore APR. Look at box A charges and your interest rate and compare based off of that. The last one, this one has never, ever caught on, Jeb. No one has ever asked me, what is my tip with your loan? They made this up when they came out with the loan.
Your tip is, if you need a good lender, reach out to Josh. You know, if you want somebody to walk you through this process, reach out to us directly. There's a referral link in the description of this video, and we can help you anywhere nationwide. So that's the tip, Josh. You don't even need to go into the rest of that.
Okay, perfect. It basically just shows if you paid that loan out for 30 years, how much interest did you pay as a percentage of your loan amount? So the last section here, hey, Jeb, look, there's that missing full page. So that's what it looks like if you're looking at the full page. I just put them out of order. So the last section is other considerations. And this is sort of a catch-all of things that were not properly disclosed to borrowers over the years prior to us coming up with the loan estimate. So appraisal, we may order an appraisal to determine your property's value and charge you for this appraisal. We'll promptly give you a copy of appraisal. Even if your loan does not close, you can pay for an additional appraisal for your own use at your own cost. How is that helpful or pertinent to the loan estimate? I don't know. Assumption. If you sell or transfer this loan to another person, we will allow or will not allow assumption of the loan. We've done episodes on this, Jeb. Other than government loans, FHA, VA, they're not going to be assumable. So really, the box isn't super relevant. Homeowners insurance. Jeb, this is shocking. People were shocked to find out that the loan requires homeowners insurance on the property, which you may obtain from a company of your choice that we find acceptable. So we've talked about this in light of all the chaos with homeowners insurance recently. Some people that own their home free and clear are choosing to self-insure. I'm going to save money in case there's a catastrophe. I'm not paying this every month. If you have a loan, the lender's not going to go for that. They're going to say, you are going to insure this so that if there's a catastrophe, I am made whole and I don't end up with a vacant lot. Late payment, it lets you know if your payment is more than 15 days late. We'll charge a late fee of 5%, and that can vary from lender to lender. So the terms of that will be listed there. This one kills me, Jeb. Refinance. Refinancing this loan will depend on your future financial situation, the property value, and market conditions. You may not be able to refinance this loan. That's because in 2003, 2004, 2005, we had lots of loan officers telling people, just take this horrific loan, get into the house. It's going to go up 25%, and then we'll refinance you into a better loan at that point. Lots of assumptions there, and they're just spelling out for you to not assume that you will have the ability to refinance in the future. And the last one is servicing. It says we do or do not intend to service your loan. Even if they say we intend to service your loan, nothing in there prevents them from selling that servicing 2 months, 6 months, 12 months down the line. So I don't know how useful that is for a borrower to look at.
So hopefully that explanation brought some clarity to what the loan estimate is. As I mentioned earlier, kind of joking around, but in all seriousness, your loan professional, your mortgage professional should be able to walk you through this and explain it just like Josh did. If they can't, you might consider going with someone else who actually can. And if you're in the process of shopping loans, again, it's okay to shop loans. We talk about it. We've done episodes on it. It's okay to shop loans, but just make sure when you're shopping, you're comparing the right things, and you're not just going off the lowest rate, because again, the lowest rate can often come with consequences that we're not going to dive into here. But if Josh can be of assistance to you, our team can be of assistance to you, do us a favor, check that referral link below. We've said this multiple times before. Josh, tells people all the time, hey, listen, you got a good loan. Just go forward with it. You're good to go. And then other cases, it's like your loan sucks. You definitely need to have a different conversation. We need to, walk you through this, get you a better rate, get you better fees, all of that good stuff. So Josh, if you wanted to, again, in your lingo, tie this up, put a little bow on it, what would you say?
I would just go back and reiterate that it is very important that you look at page 1 and make sure that loan estimate is locked if you believe it's locked, that you understand what it means and what can change if it is not locked. And remember that in terms of terms and shopping on a purchase mortgage, what you are really looking at is your interest rate and your box A fees. I have people all the time that will tell me, I really love your quote and your interest rate is really good, but the cash to close is less with this other person. And we look and box A is higher. And I go, okay, well, if box A is higher, either I screwed up and quoted the other fees too high, or they intentionally misled you by putting it lower. And I'll let you guess which I generally believe is the issue. But there are people out there that will manipulate this loan estimate process up front, especially when it's not an official loan estimate. You don't have a property yet, because they want to look as attractive as possible, or they just don't know. So this is where we fall back and say that absolutely 200% you deserve competitive rate and fees, but chasing the absolute rock bottom lowest rate and fees will generally lead you to someone who is lacking that knowledge and expertise that you need to guide you in this process and make the best decisions for you and your family.
Good stuff. So if we can be of assistance to you, do us a favor, reach out directly. Let us know what you think about the loan estimate. What do you think about this type of episode where we're walking through it? Let us know in the comments below. But until next time, guys, borrow right, buy right. What the hell's our quote, Josh? Buy right, borrow smart, build wealth. Until next time, adios.
Amigos.